Yeah, hello guys. In this video, I want to show you how you can identify an inducement, how you can pick your entry, the POIs that are valid, the one that are not valid, then how you can avoid being an inducement, or let me say be a liquidity in the market. So let's go. In this video, look at this. Let me use small diagram as an illustration. If the market is doing this, you see this level, this first pullback is a liquidity. Don't be tempted to actually want to sell from here. It's better you wait for this level and sell. Every other thing is SMT. You sell from here. Let's say market do this and mitigate this level and drop. That's when we have break of structure. This level is confirmed as break of structure. It means that this high must be protected. So if you have this situation, you see this level, this will serve as your inducement. You can sell from here like this or extreme. This extreme is high probability because it means the market has first attempt to use this as a liquidity, then use this as a liquidity, then drop. So if you have a situation like this break of structure. The process continue, liquidity, inducement, and POI. You can sell from here using your entry confirmation or this level. So let's say you have a situation whereby markets refuse to come here and create another low. You see, this one will now serve as your new inducement. This one will not be valid again because by then it will become an SMT. It will become a liquidity for this. So you will be looking to sell from here, to sell from this immediate pullback after your inducement. That's where you'll be looking to sell for, not this one anymore. So you sell from here after market take out this level or here, because this level serves as liquidity for this POI, and this level, sorry, my hand is not straight, and this level also serves as liquidity for this POI. So let me show you in the chart how this thing really work. Look at this. Let's say we have a swing low from here. Let's say market is coming down. Market creates this pullback, create this pullback, and drop like this. You can see that this is our last high, and the market actually decided to take out this high. After that, market mitigates, sweep this high like this, then drop. So it's better you wait for something like this to happen, then confirm this level as a break of structure. Once it's confirmed as a break of structure, this level as a break of structure, then you start again by identifying your POI, which I don't want this video to be rough, but I will just explain this video. So this will serve as your POI, and sorry, as your inducement because it's the last pullback. But you can see market refuse to come there and create another push back and push down, then market finally drop. This is not a break of structure. That's why I refuse to label it. So you see market push down, push up, push down, push up, then finally create inducement. And as I said, the first POI, the first pullback that is valid after market created a and take out inducement is valid. You see, we pick this level and we pick this level. This one has been mitigated. This POI has been mitigated like this. So that's why we can't use this level because it's not valid anymore. So this is valid because it's a valid pullback. So you see, you can look for your entry confirmation here and sell. And you can see market did the same thing, collapse, collapse. At the end of the day, gave us an inducement. This was our first inducement, second inducement, third inducement. So this is the last one we are using. So as you can see, market went back. This is the first pullback. They are valid. Market is supposed to come to extreme, but it refused to come to extreme. So you can see that market mitigates this one and market push down. So look at this scenario. Market repeat the same process. Use this level as an inducement because this is where we have our pullback, valid pullback. Then finally this level became our valid pullback. So as you can see, market actually went back, mitigate this level and do what? And collapse. So that's how the process will continue. Look at this. This is where we have break of structure. After the market collapse here, we have break of structure. After market got to this level and collapse again. So this level is valid for break of structure. And as you see, this is our extreme. This level refused to hold. This is where we call decisional POI. But this one refused to hold and market mitigate this level. Let's even assume that you try to sell here and you had sell, but finally you got an entry here and you were able to recover all your money. So before I go, then let me explain this. You see, markets take this out as an inducement and push up, take it out, then come back and close below this level. Break of structure confirmed. But in this scenario, look at this level. When market is coming, market actually did something like this, then break. So it left a pullback here, and you see market went back there, sweep the extreme. So in this case, after you see this sweep, this is an entry for you. Then you see the way the market drop. So that's how the whole process continues. Even as big as this one, look at it. Market drop, create swing, 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 then drop. Create liquidity here, which is inducement. This is the first one. Then extreme will be somewhere here. And if you look at it, market actually went there, sweep the external liquidity zone, the external liquidity, which is the high, but refused to close above it, is a sign for sell continuation. And you see market was selling. So we are expecting the market to close below here and give us a new structure. So that's it. It's not that deep, it's not that difficult. If you follow the process, it's kind of easy. All you need to do is to just look at it, wait for valid pullback, wait for market to create a structure. See, this is a structure. This is impulse correction, impulse correction. This is not a structure. Structure need liquidity to be confirmed. So he has to take this, then go as high as he wanted, but he has to drop. This is structure. So you have your high, you have your low. So market is supposed to be ranging from this level to wherever you want to do. Maybe you do something like this, use this as liquidity, then come back, mitigate this level, then drop. So it means that your high is here. So and your low is here. So it means that when anything market want to do, you must not violate this high. You can sweep it, but must not close above it. Any candle close above here, it means we have a change of character and the process continue. So this structure, high, this high, low, high, low, high, low, high, low. This structure, these are structure. This is how you confirm structure. It's not necessary that it has to be, but it must have those criteria. For example, let's say market did something like this and decide to sweep this high, then close. It means that this high is here. So all you need to do is to wait for an inducement to be created and market mitigate here, then sell. So that's how the process continue. So that's it, guys. If you have any other question, you can ask me. So bye for now.